Robschild. Nothing I say is investment advice. Welcome to Robschild Special Edition. Are stocks a safe investment or a Ponzi scheme? And we'll start with the answer. They are neither, ever, completely a safe investment or a Ponzi scheme. But I'm going to go through some arguments that might convince you whether or not you think stocks are a safe investment or a Ponzi scheme, specifically today, June 16th, 2024. The lessons learned from this special edition are based in Benjamin Graham's teachings. Benjamin Graham has been and is still considered to be today sort of the godfather of investing. He wrote Security Analysis and The Intelligent Investor, two very famous books on financial securities. We're going to start with a comparison between what the average person thinks and what the intelligent investor thinks regarding price, specifically price of stocks. Now, you can think of this as the price of many things, but we are specifically focused on stocks today. So let's go through the way the average person thinks about stocks and how they're priced. When the stock price or the price of the market is extremely high, the average person, their opinion is that it is very safe and profitable to have stocks. When it is high, they think, okay, it's safe and offers great returns. When it's at a medium price, they think, well, it has some risk, but they're still a good investment. When stock prices are low, people think, oh, they're kind of risky. They're only really good for speculation. When stock prices are very low, the average person tends to think they are extremely risky. You'd have to be crazy to own them. And when they get dirt cheap, which happens like once every 100 years, people say things like it's a Ponzi scheme and it relies on others alone for the price. And that's sort of true. It does rely on others for the price, but is it a Ponzi scheme? You know, people tend to only think that when the price is dirt cheap as well. Next, we will go over the way that the intelligent investor thinks, and this statement here, the intelligent investor thinks the absolute opposite of what the average person thinks. So the intelligent investor, when stock prices are extremely high, they say, oof, it's like a Ponzi scheme. It relies only on others alone for the price. The price is too high. It doesn't make any sense to be this high. When they're a regular high, they say, well, it's extremely risky, and you'd really have to be kind of crazy to own them. The intelligent investor will also say when the stock prices are at a medium price, they'll say, well, they're risky, only really good for speculation. But when prices get low, the intelligent investor starts to say, well, it has some risk, but it's a good investment. It's cheap. It will probably go up in price because right now it's low in price. And then when it gets very low, the intelligent investor does not think it's extremely risky. Rather, he thinks it's actually safe and offers great returns. And when it's dirt cheap, the intelligent investor suggests that it is very safe and very profitable. Average people and intelligent investors have been thinking this way for the past 100 years plus. Are you the average person, or are you an intelligent investor? When stocks are dirt cheap, do you feel like they're a Ponzi scheme and they rely only on others for the price? Or do you think that they are very safe and profitable? And when they're really high, do you think that they are very safe and profitable? Or do you think it's like a Ponzi scheme and relies on others alone for the price? Pretty soon, in this video, in a little bit, we will be discussing, well, how do I know if prices are extremely high or dirt cheap? I mean, if they keep going up and up and up, then maybe they're cheap today because they'll be more expensive tomorrow. We're going to go over that answer. That's really one of the main questions we're going to answer through this video to determine if the intelligent investor thinks that stock prices are extremely high, medium, low, very low, or dirt cheap. And that's how we're going to determine if stocks are more like a Ponzi scheme if they're really high, or if they're dirt cheap and therefore very safe and very profitable. Before we do that, we're going to go over a quick history of what the average person thought about stocks from before the 1920s until today. Before the 1920s, stocks were actually considered to only be a businessman's domain and not really an investment. Only bonds were considered to be investment, specifically high-grade bonds. By the time we get to 1929, everyone is investing in stocks as an investment. Notably, there was an article in a women's magazine right before the Great Crash that he wrote in there that everyone should be rich. The party was going. Everybody loved stocks because they were super expensive. They kept going up to the moon. They couldn't be stopped. And then what happened? Well, the Great Depression, the Great Crash of the stock market. And then your average person at this point, from 1930 until 1949, agreed, stocks are way too speculative. I would never want to own a stock ever again. Do you hear what happened to my parents, to my grandparents, to my neighbor, to my cousin, to everyone I know? They got hurt so bad in 1929, there's no way I could ever buy a stock again. When in fact, that may have been the best time to buy stock. The intelligent investor knew stocks were cheap then, and they were buying them hand over fist. But the average person goes on, and figures out finally by 1949 to 1959 that stocks were previously too cheap. And so, people warmed up to the idea, and the price of stocks had an amazing bull market from 1949 to 1959. In the 60s, everybody loved stocks. Stocks were great. We have another crash of, it was 69, and another one 72 to 74, I believe, where people were saying stocks are dangerous again, and they didn't provide great returns along with pretty bad inflation, and so people were scared off. And then 1982 to 2000, stocks are great. 2000, oops, dot-com bust. Everybody runs away. Everybody hates stocks again. 2003 to 2007, stocks go up and up and up. Stocks are great, says the common man, especially right before 2008. And then 2008 hits. Whoops, great financial crisis. And then 2010 to 2019, stocks can never stop going up, says everybody. 2020, hiccup. Stocks stonks to the moon, calls on GME. 2024 and beyond, we'll see. And my question here, what could possibly go wrong? On to the burning question. Robschild, I have a question. How can you tell if stock prices are high or low? And I'm going to give you the answer to that question. The price does matter, right? It goes up and down. You see it on the chart. You see it in your retirement account, or if you are an active investor, you're seeing the value of your stocks go up and down. And when they're up, maybe they're high, maybe they're not, because they could keep going up. I don't know. Well, the price, I'm going to answer that the price doesn't matter by itself. And in order to determine if stocks are expensive or cheap, they're really based on three key things: dividend yields, PE ratios, in comparison to bond yields. And we're going to break down each one of these three ways of determining if stocks are expensive or cheap right now. So let's take a look at the first metric. The first metric is dividend yields. So first we're going to define this for anybody that doesn't know or wants to review this. The dividend yield is how much a stock pays you directly, usually expressed as a percent. For example, let's say you have a stock that pays you, it sends you into your account $10 a year. Well, that means the dividend yield is 10% if the price is $100. So if you have something and it says it's worth $100 and it's paying you $10 a year, that means that the dividend yield is 10%. Now, let's say the price jumps up to $1,000 per share of that same stock, and they haven't changed their dividend payment. It's still only $10. Well, guess what? Now, the dividend yield is 1%. So a high dividend yield means that the stock is very cheap, right? You're only paying $100 for that $10 a year, whereas a low dividend yield, like 1%, means that the stock is expensive, very expensive. You're only getting 1% return. You're only getting $10 for $1,000 worth of stock. So to determine if stocks are expensive or cheap today, we're actually going to look at the historical dividend yield of the S&P 500. Here is a chart of the S&P 500 dividend yield, or what would represent the S&P 500. The chart goes back quite a ways, and we can see how much money have people been getting paid for their stocks at what percentage level. You can see the numbers from here, 0 to 9 to 14, all the way up here at one point. And let's go through that history a little bit. So starting in 1880, we can see that we are bouncing around between 6%, 9%, 4%. Really, 4% was kind of the bottom through the 70s, 80s, and 90s. That's the 1800s. And then we had a little bit of a dip before the 1900s, right? Staying basically around 4%. It seems like 4%, 3% was low, and overall maybe 7 or 8% was considered to be high. And every once in a while we get as high or even over 10% a few times. But I just want to point out that number 10 because of the example we had. We've seen 10% yield on the S&P 500, and so that would mean $100 of stock was getting you a $10 return. So to get a $10 payment, you had to have $100 of stock, and so obviously that's very, very, very high and rarely seen to go all the way up there. Moving on through history, we get pretty violent between fear and greed here, between only around the 3% range, 8% range, 9% range, back down to 3 or 4% range, 7%. And then from the 60s, it looks like we had a bottom of 3%. So 3%, we kept bumping along at it and didn't really get too much higher than that, but we did. We're still within a similar overall range. In the mid 80s, stocks got to the point where they were again having around a 6% yield. And then since then, yields of the S&P 500 dropped all the way to a low in August 2000 to 1.11%. Now I want to bring up that number just to emphasize that every once in a while we get at least decently close to that 10%, where $10 only costs $100 a stock, and when it's at 1.1%, if it was 1%, it would be $1,000 for that same $10 return. I want to emphasize how great of a difference there is between dividend yields of the past and the dividend yields of more recent history. Since 2000, right before the dot-com bubble, by the way, and that's what a bubble looks like when dividends get crazily low, it may indicate that we might be in a bubble, right? So since then, we've gone back up to and above the 3% mark around 2010. It almost looked like we might be going back to a period of normalcy for that in that regard, but then we go back down to around 2% and hover around there for a while, and more recently in the 2020s, we've gone back down to a current low of about 1.3%. Again, $1,000 for $10 return versus $100 for $10 return. So according to this metric, by itself anyway, according to dividend yields, stocks today at 1.3% yield are probably extremely expensive compared to the price of stocks in the past. But Robschild, my investment advisor, says dividend yields don't matter anymore because what the company does is instead of giving you the money, they hold the money and they invest it so that they can make even more money. Wait a minute. I mean, it's not exactly a Ponzi scheme, but I'm going to go over some similar characteristics to that kind of logic. So, firstly, it depends on more investment. It needs new investments to grow and to keep running. And so it's keeping its earnings instead of paying the shareholders dividends. It's keeping the money. It's not paying it out. Similar to a Ponzi scheme. This isn't a Ponzi scheme, but we're going in that direction when dividend yields get this low. They keep the money. They hold on to the profits to reinvest rather than distributing the shareholders. Basically just said that. Delays payments. Makes it harder for investors to get returns as profits reinvested into longer term projects instead of paying it out. Don't worry, we're making that money make you more money, right? And then, so in order to cash out, you actually, it takes a little bit of more active investing to realize the profits of a company. Like, let's say they're investing the money and it's making more money. Well, that's great, but it also depends on the shareholders to sell some of their shares and be like, okay, that's great. I want some of my money back. But the problem with that is that doing that relies completely on the stock price, on the current stock price, and you don't have control of that. The market determines at any given point how much you can get for your stocks. And so investors are depending on the stock price going up to make money rather than having the company simply just pay them some of the profits. Admittedly, though, this is the weakest of the three metrics that we're going to take a look at. It is true, companies can withhold earnings, reinvest it, and therefore make more money. So let's go ahead and pretend that it isn't at all like a Ponzi scheme, whether you think it is or maybe you're like, Robschild, you don't know what you're talking about. After all, what really matters is how much money companies earn, not how much they pay out to the investors. It's what, at the end of the day, how much do they earn? So let's talk about it through P/E ratios. The P/E ratio represents how expensive it is to earn money. For example, company XYZ stock is worth $100 and the P/E ratio is $10. That means that the company is earning $10 a year. Now let's say the stock price of this company goes up to $200, but let's just pretend for the example's sake that the company still only earns $10 a year. Well, now the P/E ratio is 20, and so generally speaking, a higher PE ratio means that the cost of earning money is higher. And an easy way to calculate this in your head when you're looking at the PE ratio of the S&P 500 or a specific stock is this way. The PE equals $1 of earnings per year. In other words, if a PE of a company is 4, then it means every $4 of stock earns $1. So it's earning $1 for every $4 of stock. Now, that would be a very low PE ratio, right? Because you only need $4 of stock to earn $1. Versus, for example, if you had a PE ratio of 50, because that means every $50 of stock earns $1. So in order to own $1 of earnings from a company, if it's 4, you're only paying $4 for that stock. If it's 50, you're paying $50 for that stock. So high PE ratio means it's expensive. Low PE ratio means it is cheap. Well, what about the S&P 500? Let's take a look. Here is a trailing 12-month PE ratio history of the S&P 500 going back to 1871, or stocks that represent the S&P 500. As you can see, from 1871 all the way up until about the year 2000, we never got to the PE ratio of 30. That would be considered to be very high, and therefore stocks being very expensive relative to their earnings. But ever since 2000, we've basically hardly ever dipped very far below what looks like 19 for the PE ratio. I will note that part of the reasoning for the PE ratio to be generally higher has to do with bond yields, the yields that you can get for guaranteed securities. And that's our third and final point that we'll be reviewing in the next section. This section, we're simply trying to get a gauge whether stocks are expensive, only looking at PE ratios. The other important thing to realize about these PE ratios is that when the PE ratio is spiking, as you see happened in 2009, all the way up to the moon, I don't even know, it's off the chart here, that was largely a consequence of earnings actually going lower. So there's two ways that the PE ratio goes higher. It's when the stock price is going up higher while earnings are staying the same, or the stock price is staying the same or even dropping like it did in 2009, but the earnings dropped so much more than that that relatively speaking, stocks got even more expensive. Now, in 2024, I can tell you we have not seen very much earnings contraction. We are not at a very low earnings period compared to recent history, and we will also look at that chart in a moment. The point I want to express with this chart here is to simply say that from a historical perspective, our current PE ratio of the S&P 500 is at 28, and besides these spikes that largely came from earnings contractions, we've never really seen it this high besides those, outside of those spikes. This spike here, however, in 1999 was obviously leading into the dot-com bubble, where stock valuations got very, very high compared to their earnings, and we all know what happened after that. I'm going to suggest to the viewer that today's PE ratio of 28.33 is extremely high from a historical standpoint. One argument people often make is some people will say, A high PE ratio is the new normal because company earnings will just keep going up and up. So it is safe. While this is entirely correct from a very long perspective, taking a zoom out, yes, earnings of companies generally go up as inflation goes up over very, very long time periods. However, in slightly shorter time periods, which some of these short time periods, by the way, can last longer than you might think, earnings can actually go down, and they have. And we're going to look at a chart that shows that. This is a really good interactive chart from macrotrends.net of the S&P 500 earnings, a 90-year historical chart. And we're going to be taking a look at the orange line. This is showing us how much money, what is the earnings per share of the S&P 500 all the way back to 1928. So to get a better view of this, we're actually going to zoom in. But like I said before, the earnings over long periods of time, the earnings go up, right? So back in 1928, the earnings per share was $1.50, and today we're closer to around $200 per share of the S&P 500. So zooming in on this chart, you can see that earnings sometimes go up and sometimes they go down. You can ignore the blue. The blue is the price of the S&P 500. We're not talking about that right now. In fact, this relationship between the blue line and the orange line we've already talked about. That's the PE ratio, is the difference between the price and the earnings per share. We're only looking at the earnings per share because of the idea that as long as earnings per share goes up and up and up, well then it doesn't matter. The price can keep going up. The price of the S&P 500 is perfectly fine. But as you can see, we have periods from 2007 where the earnings per share went from 84 all the way down to $7. That is a pretty steep decline. Granted, it didn't take that long to recover, but there was a period of contraction, and notably from 2007 of an earnings per share of $84, $85, we've actually seen that price again in 2012, 5 years later, again in 2016, and not that much higher in 2020 when we had that dip there. And you can see this throughout history that earnings don't always go straight up. In fact, there's plenty of periods where they go down and we don't even get to new highs for many years. So we can very clearly see earnings don't always go up. I'm going to scroll back to the next time frame here just to show, let's take a look here from this perspective. From 1980, we have in 78, $11 per share, $15 a share, back down to $12 a share, up to 16, down to 14, up to 25, all the way back down to 16. Sometimes earnings go down. I can't emphasize this enough. And you never know how long they're going to go down for and how long they're going to be flat. From 1961, they went up and up and up and up and up and up. That was great. In 1966, we went down a little bit, we went up a little higher, and then we went down further. We had an earnings contraction so bad in 1970 where it went down to $5 per share. We hadn't seen that price since, I guess it was 4 or 5 years earlier. We lost 5 years. 5 years we went flat for earnings. So they don't always go up. In fact, after large bull markets, inclines of earnings, we do often see periods of flatness at the very least. Moving back even further, we have periods where earnings go down, earnings go up, earnings go down, earnings go up, earnings go down, earnings go up. There's a nice little sideways period here as well, from about 1954, 55, all the way through 1961. For 6 years, 6 years, earnings went flat. Going back further in this chart, very notably, this was really the real big one when earnings per share in 1929 were $1.55 a share, and we actually dropped to 42 cents a share. So that's a decline of 75%, I believe, of earnings per share. And we hadn't seen that number value from 1929 of the S&P 500 all the way up until 1947. And so this just represents, what can happen when, for example, PE ratio is high, or, people are speculating that, the things are just going to go up forever, and then they don't for a very long time. 1929 until let's call it 49 for easy sake. So that's 20 years after 1929. Earnings were actually lower in numerical terms. This is all while inflation is happening and everything's getting more expensive, and so you wouldn't have had a real return for quite a bit longer than that as far as the value goes, looking at earnings per share of the S&P 500. $1 in 1929 was worth a lot more than $1 in 1949. So my response to people saying that high PE ratio is the new normal and that company earnings will just keep going up and therefore it is safe, this is just downright wrong. This is incorrect, as we've seen. Company earnings can and will go flat, and they can go down as well, significantly, as we just saw in that chart. So back to talking about the fact that the PE ratio is historically pretty high. Well, let's take a look at similar Ponzi scheme characteristics. If I'm saying it's expensive and it's high, then how's it related to a Ponzi scheme? Again, depends on more investment. It needs buyers and other investors to continuously bid up the price, no matter how expensive the earnings get. It's depending on more people buying it for higher and higher prices. That's what is keeping stocks prices elevated at this moment in June 2024. It relies on stock price. Investors depend on other investors to keep buying the stock no matter how expensive it gets. A good argument to be made is interest rates have been very low. Therefore, the earnings of companies have to compete with those bond yields. When bond yields are really dirt cheap, then it's like, well, the guaranteed return, it's guaranteed, but it's so small, relatively speaking, the cost of earnings should be higher because, the guaranteed payments are so low. So how does that all work? Again, a guaranteed return should be lower than potential returns that have risk. So when we're comparing the return of bond yields to what stocks can make, what kind of money stocks can make, bonds are a guaranteed payment. They guarantee payment, and it's the same payment though. It doesn't change. Whereas earnings typically increase over time, but don't always increase over time. So for stocks, we're hoping that the earnings is going to go up, and we know that earnings usually increase over time, although there's no guarantee of that. Now, I'm going to suggest that if we have a hypothetical situation, where bond yields have an elevated yield and PE ratios of stocks are high, and dividend yields are low, then relatively speaking, compared to what you can get for the return on bonds, stocks are very expensive. Again, this is depending mostly on this one point here. Do bonds have an elevated yield? This chart here compares the dividend yield of the S&P 500, which is in orange, which is actually not the part we're focusing on right now. We're focusing on the 10-year Treasury bond yield, which unfortunately this chart actually ends around 2020. I had to draw this line here, but trust me, you're going to have to trust me on this one. This is correct for 2024. It looks kind of ridiculous, doesn't it? And it should look ridiculous. This chart actually, it only goes back to 2011, but it still makes a really good point. As you can see, bond yields, I said, PE ratios on stocks, they have been so much higher than history for the past 20 years. It's like, well, that partially is because the 10-year, the bond yield, the Treasury bond yield, the money you can get from the government, guaranteed return, has been relatively lower, and so stocks can be more expensive. That kind of makes sense, all right? But taking a look here at the 10-year Treasury yield going back to this goes back only to 2011. But as you can see from 2011, below 4%, going down between 1 and 2%. Again, generally between 1 and 3%. We go up just a little above 3% in 2019, and then all the way back down to just over 1%. Now, what's happened very recently is bond yields have gone much, much higher. The current 10-year Treasury yield today is 4.4. So actually, I drew this incorrectly. It's even a little bit higher than what I drew it. I'll use my red marker to show closer to 4.4%. So this is where we are right now. And here's the question, are bond yields elevated? I would say by this chart, they certainly look elevated. Now, to be fair, bond yields have been higher in the past. And in fact, looking at this chart, current view going back to the 90s, is really since 1980, we've seen 10-year Treasury yield going down and down and down. But the main point here is that we haven't seen Treasury yields in this area this high since 2007. And all while, we're still accepting high PE ratios and low dividend yields all at the same time. You can't take a look at one of the things that I'm sharing today and determine whether stocks are expensive or cheap. You really need to take a look at those three things and combine them together. Back to our essential question of this entire video. Are stocks a safe investment or a Ponzi scheme? Are they safe or are they a Ponzi scheme? The answer, it depends on the price. Are they expensive or cheap? As we went over at the beginning part of the video. And I'm going to state that today stocks currently have a historically low dividend yield and a historically high PE ratio, and bonds have a historically high yield, especially compared to PE ratios and dividend yields. So our conclusion from these data points is, in June 2024, stocks are very expensive and have similar characteristics as Ponzi schemes because of the high price. Not investment advice. I hope you enjoyed Robschild's special edition, Are Stocks Safe Investment or a Ponzi Scheme? Hope you enjoyed. Thank you for watching. Robschild.